All right. Good morning. Hopefully you all can hear me. Maybe Nicole, Jessica, give me a thumbs up if you can hear me okay. Awesome. All right. So thank you for joining our discussion on financial acumen and how it can help you evaluate your business performance. I'd also like to thank all of our event sponsors that help to make these programs possible. My name is Stephanie Narvadas. I'm the CFO for Healthy Systems and a board member for the Alliance of Women in Workers' Compensation. I'm presenting today with Nicole Vargas, who is the CFO for Ringler and also a board member with the Alliance, and Jessica Resch, who is the Director of Revenue Recognition for Healthy Systems. So let's get started with an introduction to business performance evaluation. One thing I'd like to say before we get started is we will be discussing financial statements. So 3 different components, the P&L, balance sheet, and cash flow statement. And as we discuss this, you'll see that the financial statements are like a report card for companies. They tell us if the company's doing well or where they need to improve. So as you follow along, just be thinking about that as we discuss the financial metrics. The other thing I'd like to say is we're going to be asking reflective questions for the audience. So, as I ask these reflective questions, if you could put your thoughts in the chat, that'll help stimulate some of the thought and conversation. So,
Stephanie, I was going to say, I have a quick question for you. Which
sure.
financial metrics do you actually prioritize?
Oh, that's a great question, especially to start out. So we'll talk about this in more detail, but I tend to focus on gross profit and gross margin because that tells me how much profit our company is making selling our core products and services. One thing to say about gross profit is I like to compare it to my net paycheck. So my net paycheck, I'm using that to pay my mortgage, my car payment, my utilities, my insurance, and all of my costs to run my home. And gross profit is like that for the company because that's what they have available to pay all of their operating expenses, which you'll see are very similar to your own expenses: rent, insurance, utilities. So without a healthy gross profit, you may end up with an overall net loss. And we'll get more into that, but that's the one I look at. For the audience, a reflective question is just think about a personal project that you've worked on and what metrics did you use or how did you know that your project was successful? And it can be a personal project or something that you did at work, but how did you measure your success? And while you're thinking about that, I will get started with the profit and loss statement, which is also known as the P&L. So the P&L summarizes the revenues, cost of revenues, and expenses incurred during a specific period of time. So you're usually looking at a month, a quarter, or a year. Other names for the P&L that you might hear are statement of operations, statement of earnings, or statement of financial results. But for today's purposes, I will just call it the P&L. And it basically tells us whether the company is earning more than it spends. So it's very simple, but there are a lot of different components. So every company needs to know how well their business has done. And without this information, the key stakeholders, such as your executives at your company, managers, employees, your creditors, and investors, would really have no idea how the business is doing and where they would go next. So here are the key components of the P&L. I'm going to go over these pretty quickly because we're going to dive deeper into them in some upcoming slides. But first, we'll talk about revenues, which is at the very top. Your revenues are how much the business billed its customers for the products or services you've provided. So, revenue should be relatively straightforward, but it's one of the trouble areas. Most companies do get in trouble due to misstated revenues usually because they're not recording them at the right time. So when revenue is recognized, it doesn't mean that the cash has actually changed hands, unless, of course, your company uses cash basis accounting. But most companies are required to report their revenues on an accrual basis, which means for revenues when they earned it. So the revenue is considered earned when the service or product has been delivered and accepted by the buyer. Another thing to know about revenues is that some companies will need to book adjustments to their revenues. Some examples of the adjustments are volume discounts, returns, and allowances. So revenues shown net of these items is known as net revenue. And tracking the trends in these adjustments can be very important for operations, because if you're seeing a lot of returns of your product or you're having to give a lot of discounts, it could mean that your quality of your service or product is declining. So next, after revenues, we've got your cost of goods or services sold. And like revenues, cost of goods sold can include many components. So cost of goods sold is the cost to manufacture or purchase the goods being sold or to deliver the service. So companies that sell services will have direct costs for the services it provides, which includes the salaries of those involved in providing the service. So when a company has delivered their product or service and completed the sale, the cost is recorded at that same time, because you always want to match your cost of goods sold with the related revenue and record it in the same period. So cost of goods sold is another area that operations should trend, since if you have increasing costs to produce your product, it can impact your profit margins. So once you've subtracted out your cost of goods or services sold, you come to gross profit. This is something we'll discuss further. But as I mentioned earlier, this is the amount the company has available to spend on all of its selling, general, and administrative costs. So after gross profit, you're going to subtract out your selling, general, and administrative expenses, which are your operating expenses that are not directly related to the production of the goods or delivery of the services. So examples of this are your administrative employees like accounting, HR, marketing, and everything else that's involved in operating the business that's not directly related to the production of the goods or service. So after those are subtracted out, you'll come down to operating income, or as it's also known, EBITDA. So we'll talk a little bit more about this, but EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And then once you've subtracted out your interest, taxes, depreciation, and amortization, you come down to your very bottom line, which will be net income, and hopefully not a net loss. So those are all the components. I'll take a moment to ask a question. So Jessica, could you share a time you used a P&L to uncover an issue with expenses in your department?
Sure thing. Hi, everyone. This is a very small and simple example, but a while ago, I noticed that our department was under budget on internet reimbursements, so our expenses looked wonky. Yes, that is a technical accounting term, wonky. Anyway, we were a small team, and we didn't have any personnel changes, so there was no obvious explanation as to why there would be a variance. The P&L is typically a high level tool, but because it didn't look right, I started to dig deeper and saw that there was an issue with how the reimbursements were being set up. So catching this early through using the P&L let me address the problem quickly and made sure everyone received their reimbursements before they escalated it or before it became a bigger issue. So that was just one simple example. But thank you for the question, Steph.
Yeah, that's a really good example, on how you can use your P&L, even if it's just for your department. So for the audience, a reflective question: have you ever created a personal budget? And if so, can you think about how tracking your income and expenses in your life is similar to what a company does with its P&L. All right, so moving along to gross profit. Gross profit, as I mentioned, is calculated as your net revenues minus your cost of goods or services sold. And gross profit includes the variable costs that are directly related to producing or delivering the goods or services sold. Your gross profit would not include your fixed costs that have to be paid regardless of your level of output. So your rent, your insurance, those will always stay the same regardless of how many widgets you're producing or how much services you're producing. So gross profit tells you how much profit the company is making before deducting the operating expenses. And gross profit trends can tell operations how well we're purchasing or how well we're controlling our costs to deliver our service. And it can tell us whether our product is priced correctly in the market. So another question, this one for Nicole. So what do you find most important when you're analyzing your company's gross profit?
Okay, great question, Stephanie. So when analyzing gross profit, it's essential to approach it from both a broader year-over-year perspective and also a more detailed month-over-month view. So the year-over-year trends help identify patterns, such as like seasonality that might be evolving and giving insights to the overall business consistency. But on the other hand, those month over month analysis, it's great for catching those short-term fluctuations, such as those spikes or drops. And that might actually be hidden in that long-term view. So it's important to dig into those monthly changes to see if they're likely to continue or is it just a one-off. But in terms of like revenue growth compared to the expenses for the gross profit analysis, I always ask, are costs rising faster than the revenue is just being generated? So this could point out like a need for adjusting your pricing or maybe addressing inefficiencies. The gross profit, it's a valuable metric, but it only tells part of that story. So we need to consider that alongside with the aspects of business, like you explained, with costs that support the business, like software, rent, and insurance. So ultimately, though, the gross profit is just one part of that bigger financial picture, and understanding how it fits into that overall business performance, it's crucial for making informed decisions.
No, that's a great answer. And now I have a question for the audience, a reflective question that kind of plays on what you just said. So imagine you're running a business, and if your costs to produce your goods or deliver your services suddenly increased, let's say due to inflation, but your revenue stayed the same, what might you do to keep your gross profit healthy? All right, and while you're discussing that, we'll move on to gross margin. So gross margin, as you can see from this slide, is a percentage, whereas gross profit is a dollar value. So gross margin percentage is calculated by dividing your gross profit into your revenues. And you can use it to compare. You can compare your gross margin to your competitors or to your results from previous periods. So to increase your gross margin, you can decrease your costs or increase your pricing, or you can do a little bit of both.
So Stephanie, I have a quick question for you. Why do you think the gross margin percentage is important? And is it more important than looking at just the gross profit in general?
That's a great question. I think both are important, but gross margin percentage helps to measure profitability efficiency. And what I mean by that is a higher gross margin percentage indicates that a company retains more money from each dollar of revenue. So if you had a 20% gross margin percentage, that means you're retaining 20 cents for every dollar of revenue you bring in. Whereas if you're at 10%, you're only bringing in 10 cents per dollar. So the 20% margin percentage is more efficient. You're gaining more out of each dollar of your revenue. The other thing is because it's a percentage, it allows for easy comparisons between companies of different sizes, where you can't compare your gross profit dollars if you're a smaller company to the larger companies. But it's a key metric for investors that they look at. They look at trends in your gross margin percentage over time to assess whether your company is improving or worsening their cost controls relative to revenue. So I would say both are important, but gross margin is often more valuable for assessing your operational efficiency and making comparisons. All right, so that's a lot of information so far, but as you remember from my chart, after gross profit, um, you're going to subtract out your selling, general, and administrative expenses. So you always want to make sure that your gross profit is high enough to be able to cover these fixed costs, such as your rent, your utilities, insurance, your salaries, benefits, and payroll taxes for your administrative employees. So these are all of the other costs that are included here after gross profit. So that they're subtracted out of gross profit to arrive at your net operating income or net operating loss. And so your net operating income is also referred to as EBITDA. And I'm sure you've heard this term at some point. And as I mentioned, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And EBITDA is commonly used to compare companies' earnings. Analysts and investors use EBITDA to compare the profitability among companies because it eliminates the effects of the company raising debt or differences related to their tax structure or accounting decisions related to their depreciation methods. So I'll give an example. If you have a company that's an LLC versus a company that's a corporation, the corporation will have taxes as part of their P&L, but the pass-through entity, the LLC, would not have taxes. So EBITDA eliminates that by looking at it before the taxes are deducted. So it makes the companies more comparable. The last thing I'll say about EBITDA is it's used oftentimes by private equity and other investors to value your company. So your EBITDA would be used with a multiple of maybe like 8 or 10 times that number to value your company.
So Stephanie, real quick, how would you explain the difference between depreciation and amortization?
I get that question a lot, and I do think it's kind of silly that there are two different things because they're both methods of allocating the cost of an asset over its useful life. So meaning that the asset is capitalized to the balance sheet, and then the depreciation or amortization on that asset is recorded on the P&L over the years that it's being amortized or depreciated. The only real difference is that tangible assets such as equipment and computers or even buildings and vehicles, those are depreciated, whereas intangible assets such as patents and trademarks are amortized. So depreciation is based on the useful life of an asset. So if you think about a computer, how long is your computer good for? It's really got a useful life of 3 years at the most. So that would be the period of time that that cost would be depreciated onto the P&L. And then amortization is based on the legal life of the asset, such as the duration of the patent would be the amortization.
Thank you.
All right, and now we're at the very bottom of the P&L, and that's why it's called the bottom line. So net income, which could also be net loss, is, after EBITDA, you subtract out your interest, taxes, depreciation, and amortization. And now that everything has been subtracted out, you're at your very bottom line. And, net income is an important number, especially to publicly held companies, because it's used to calculate the earnings per share. They take their net income divided by their outstanding shares. All right, so kind of putting it all together, I'm showing a P&L for a company for the year ended December 31st, 2019, as compared to December 31st, 2020. And you can see we've got our revenues and gross profit here at the top. I'm also showing the gross margin percentage off to the side here. And then you have all your selling, general, administrative expenses coming down to EBITDA. And then once you've subtracted out your depreciation and amortization and interest expense and taxes, you get down to your net income or net loss. As you see, they have a loss in 2020. So one thing I'll say about this is you can see this company has lost about $80 million in revenue in 2020 compared to 2019. And then similarly, they've had a loss of $12 million on their gross profit as a result of the revenues going down. Their gross margin percentage stayed the same at 15%. So they're still earning 15 cents per every dollar of revenue earned. They just had a decline in their volumes of revenue, which a lot of companies did during 2020. So a reflective question for the audience, what could this company do knowing that their gross profit has declined by $12 million to keep their bottom line healthy, their net income or loss? So go ahead and if you can, share any thoughts in the chat. And I will turn it over now to Jessica Resch, who's the Director of Revenue Recognition here at Healthy. And I'll say, Jessica, I'm really happy that you're able to join us. We both went through Hurricane Helene last week, and Jessica had a little bit more of an issue than I did, but we're really glad that she's here with us today and appreciate it.
Of course. Thank you, Steph. And hi again, everyone. It's nice to virtually meet you all. Stephanie is my boss's boss, so I'm going to be on my best behavior today while we talk about a company's balance sheet. So I actually come from a data analytics background, not finance. So I get that this can feel overwhelming at first, and it feels like there's a lot of new terminology and verbiage being thrown your way. Don't worry, we're going to get through this together and break everything down piece by piece. So if you have any questions or thoughts, please put them in the chat, and let's start talking about the balance sheet. So first, what is a balance sheet? It's basically a snapshot of a company's financial health at any given moment. So you can kind of think about it like hitting the pause on a company's finances. It gives you a clear picture of what the business owns, what the business owes, and then what's left after covering all of its debts. It's sort of like holding up a mirror and saying, here's exactly where we're at right now. The balance sheet is split into three main parts. So you have your assets, your liabilities, and your equity. We'll talk more about what each of these mean here shortly, but just know that these sections always need to balance out following the simple equation of assets equals liabilities plus equity. This is what keeps everything in check, showing that whatever the company owns or their assets is either financed through debt or liabilities, or what the owners have invested or equity. Here is why the balance sheet matters. So businesses need to make sure they can pay their bills while still holding onto value for their owners. If the liabilities get too big compared to the business's assets, the company could potentially be in trouble. But if the equity is strong, it means the business can handle tough times, invest in itself, and keep growing. Let's move into assets. So assets are the lifeblood, really, of any company. They're everything of value that the business owns. Assets include things like cash, intellectual property, equipment, and are the resources that keep your company running and growing. There are two main types of assets. So first we have current assets, and this includes things like cash, money that's owed to the company, and for companies who have it, inventory. Current assets are the resources that can be turned into cash or used within a year. Think of it like a company's short-term liquid resources ready to go whenever they're needed. Then there are non-current assets, which are more like long-term investments. These include things like equipment, real estate, or other fixed assets that the company holds on to, usually for a while. They may not be as quick to turn into cash, but they're essential for keeping the business running smoothly over the long term. So, Stephanie, I'm going to put you on the spot here. And can you think of any assets that are uniquely found in the workers' comp space? Stephanie, I think you're on mute.
Sorry, I was
It's good.
gulping my water and I put myself on mute.
Really put you on the spot then. Sorry.
No, that's fine. So I would say that as a service provider in the workers' comp industry, one thing that we see on our balance sheet that might be different from other companies is internally developed cap software. So this is software that's capitalized, that you're actually building in-house. And it's software that you use to provide your services to your customers or that your customers can also use. So it's not software that's held, for sale, but it's used in-house. So you typically see that on your balance sheet, and then you're depreciating that over its useful life. I know there's other assets that are unique to insurance companies, and I know just a little bit about that to be dangerous, so I probably won't say anything about that here.
Well, no, that's super helpful about the
All right.
software. Yeah, definitely in the insurance space, I think claims processing systems are one that is a huge asset for a lot of
Oh
companies.
yeah,
But that was
definitely.
helpful. But now we're gonna move into my favorite topic. I mean, I am the director of revenue, so my favorite topic is accounts receivable or AR. So AR is basically the money that a company is waiting to collect from customers for products or services that have already been delivered but not yet paid for. So sort of like a waiting room for payments. It's super important for managing a company's cash flow because the faster a company collects on its receivables, the more cash it has on hand to cover expenses, pay employees, and reinvest in company growth. It's important to note that accounts receivable is not the same thing as billing. So AR is the total amount customers owe at any given time. Billings, on the other hand, are the actual invoices issued to customers for those amounts. When Well, billing does lead to accounts receivable, but AR is the cumulative total of all open and unpaid invoices. And to keep tabs on all of this and how long a company is waiting to get paid, we use something called days sales outstanding, which is not as scary as it sounds, or DSO. So DSO is a measure of how many days on average it takes for the company to collect payment after making a sale. And you can see the formula for calculating DSO here. It's AR divided by credit sales times the number of days in the period you're calculating the DSO for. A lower DSO means the company is getting cash faster, which is great for keeping things running smoothly. If accounts receivable sits too high for too long, it could potentially cause cash flow problems, meaning the company might struggle to pay its bills or fund new projects. So keeping DSO low ensures there's a steady stream of cash coming in to support the company's day-to-day operations. And on the next slide, we're going to look at a very simple example of this. So DSO can get a little confusing, so we're going to make this pretty simple. Imagine there's a company called ABC Claim Management, which ended 2018 with 1.1 million in accounts receivable. That means they're waiting to collect 1.1 million from clients who already received their services, but they haven't paid yet. On top of that, they made 3 million in credit sales during the last quarter of the year, a big chunk of revenue they're hoping to turn into cash. To stay on top of things, ABC tracks how long it takes to collect these payments by calculating their DSO. In this particular example, it takes ABC Claim Management 34 days to collect payment. Imagine doing work and then having to wait months to get paid, and that's a tough spot to be in for sure. So for ABC, if their DSO is too high, it means they're waiting too long to turn sales into cash. And if that happens, it can really slow down their ability to grow invest in new claims management technology, or even cover their own day-to-day expenses. The next part of the balance sheet we're going to talk about are liabilities. So liabilities are basically a company's IOUs, debts and financial obligations it has to pay. These can include everything from loans taken out to fund big projects to money owed to vendors or even things like unpaid wages, taxes, and utility bills. Liabilities are important because they show what the company has promised to pay, either soon or over a longer period of time. And liabilities come in two main types that we'll talk about. First are current liabilities. So these are debts that need to be paid typically within a year. Think of this as your company's short-term bills, things like rent, utilities, salaries, etc. These are the payments that keep the everyday business running smoothly. Then you have long-term liabilities, and these are the debts that can be paid off over a longer stretch of time. So these include things like loans or bonds, which might not be due for several years. Long-term liabilities often relate to bigger investments like expanding the business, buying new equipment, or things like that. It's crucial for a company to manage their liabilities so they can meet their obligations without getting into financial trouble. When done right, liabilities can help a company grow by using debt in a smart way. But if a company takes on too much debt, it could struggle to cover its basic costs or miss out on opportunities for future growth. On the next slide, we'll talk about working capital briefly. And working capital is a company's financial breathing room. It's the difference between what the company has on hand that can easily be turned into cash and what it owes in the near future. So think about working capital like the cushion that helps the business keep things running smoothly day to day. It makes sure the company has enough to cover short-term needs like paying employees, suppliers, and other operational costs while still having enough cash left over to keep things moving forward. You can have positive working capital, which means the company has enough resources to cover its short-term obligations without any financial strain. It's a good sign of liquidity, meaning the company can handle unexpected expenses, invest in new opportunities, and reinvest in itself. You can also have negative working capital, though, which could be a red flag. It might mean the company is struggling with cash flow issues, which could lead to late payments, missed chances, or even problems staying afloat. So, Nicole, can you share a time or an example of how a company's working capital affected its operations?
Yeah, thank you, Jessica, for the question. I'm going to kind of reiterate some of the points that you just brought up. So, when thinking about your working capital and how it affects your company's operations, it does come down to balance. So you do have the positive working capital where your current assets exceed your current liabilities, and that can indicate that you're not fully investing, providing that, financial cushion that we talked about. You can seize opportunities, can also get you through things like when we just had the pandemic. So it can be, a very good thing to have that cushion. But on the other hand, you also have negative working capital where your liabilities are outpacing your assets. And that can signal that you're struggling with paying just your bills or salaries. That situation, it can be risky if you're trying to make more investments, by purchasing new equipment or expanding your operations. But the way I try to always look at it too is it's kind of like your personal finances. So if you have a lower credit and you have like a negative cash working capital and you're trying to seek a loan, that could end up being where you don't qualify for the loan, you don't have that extended credit. And they compare it to your income, and it wouldn't be as well as if you had somebody in a stronger financial position. So whether a company is operating with positive or negative working capital, it's understanding their situation and their strategic goals and ensuring that there's enough liquidity to support both current operations and future growth. So again, I think it always just depends on what the goals are for like your 1 year goal, your 3 year goal, and 5 year goal. But I'd always suggest having that cushion, because you never know what's going to happen. So thank you.
Yeah, no, that makes a lot of sense. That's a great example. I have to think of my own negative working capital every time I walk into Target. So, um, but let's walk through this too with Nicole gave a very helpful example, but let's bring this idea to life with a very simple example here. So imagine a company with $22 million in current assets and 16 million in current liabilities like bills, payroll and short-term debt. The difference between the two gives the company 6 million in working capital. And this 6 million acts as a financial cushion, like Nicole was talking about. Could also be an epic party fund, you do you. Lets them comfortably cover daily expenses, though, pay off short-term obligations, and keep things running without any hiccups. So having enough working capital is like having a solid emergency fund for the business. It gives the company the flexibility to handle any unexpected expenses or delays in revenue without having to scramble for cash. And Steph, did want to ask you if you could talk a little bit about managing short-term liabilities and why that's crucial for keeping a company's day-to-day operations running.
Yeah, sure. So kind of reinforcing what you've said and what Nicole has said, a company has to monitor their short-term liabilities to ensure they have enough liquid assets to cover their short-term obligations. And it sounds really serious, and it is, because without monitoring this carefully, the company could risk running out of money. And in some cases, when companies are not monitoring this very carefully, their short-term obligations, the company might have to hold on to their payables, which means, just not paying the payables in as timely of a manner, or maybe even paying them after they've already been due. And this can cause a lot of problems because it can cause problems with your suppliers and your relationships with them. And they may even charge you late fees and penalties, which will cause you to have to make more of an expenditure, as well as a reputational damage. Because a lot of times people can actually look up the company's creditworthiness through, their DNB number or other ways. So, if your short-term liabilities are mismanaged, it could result in a disruption of your operations because of the supplier issues, and it would, limit your growth opportunities.
No, that's all really good points. You can see how it could very easily become a slippery slope to not great things. So thank you, Steph. That was very helpful. The final topic I'm going to mention is stockholders' equity. And this is basically what's left for the owners after all the company's debts and liabilities are paid off. So in simple terms, it's the company's net worth. For publicly traded companies, this represents the value available to shareholders, and for privately owned businesses, it's the value that owners have built over time. This is stockholders' equity is a big indicator of a company's financial health and really its potential for future growth. A company with strong equity is in a great spot to reinvest in new projects, take on strategic initiatives, or weather economic downturns like the pandemic that Stephanie and Nicole have mentioned. On the flip side, declining equity can be a warning sign that liabilities are starting to eat away at a company's value. So it's definitely something to pay attention to. So finally, let's land this balance sheet airplane here. And we've gone over the three main parts of a balance sheet: assets, which show what the company owes; liabilities, the debts and obligation it needs to pay; and finally, equity, which is what's left for the owners after all the debts have been paid. So just the one thing I want to leave you with is, even if you don't work in a financial role, you can still help manage accounts receivable or boost your company's balance sheet. So for example, sales and marketing can vet customers and set clear payment expectations, while customer service can foster relationships that encourage timely payments. Operations can work to make sure they deliver on time and bill accurately, which minimizes disputes often. IT can streamline tracking and provide insights into payment trends, and legal can help keep contracts clear. By collecting and gathering customer feedback, product management can refine payment terms. So the moral of the story is, you may not always see it, but you can do things every day to help manage your company's balance sheet and accounts receivable. And I briefly checked the chat. I don't see we have any questions. So with that, I will turn it over to Nicole, who's going to dive into the next section and take a closer look at cash flow statements.
Thank you, Jessica. Hi, everyone. Nicole Vargas again with Ringler Associates. So the cash flow statement focuses solely on cash transactions within a specific period, showing how cash moves in and out of the business. So it complements the balance sheet and the P&L, which operate under accrual accounting. So in accrual accounting, as Stephanie explained with the P&L, revenue and expenses are recorded when they are earned or incurred, not necessarily when the cash is exchanged. So revenue can be recognized in the P&L even if the cash hasn't been received yet, resulting in a receivable on the balance sheet, as Jessica just discussed. So later, when the cash is collected for that revenue, often a month or more down the road, it's reflected in the cash flow statement as an inflow of cash. However, this does not get counted as new revenue. A lot of people get that mixed up because it's already been recognized earlier in the P&L. So the cash collection simply just clears out the receivable on the balance sheet. And while the cash flow, it's actually just tracking the actual movement of the cash. So the cash flow statement helps understanding how the flow is going in and out of the company, and it explains the change in the cash position on the balance sheet, showing whether the cash is being generated through operations, investing activities, or financing activities. So I'm going to ask Stephanie, could you explain how a company can be profitable on paper on the P&L, but still run into a cash flow problem and even have to declare bankruptcy?
Yeah, that's a great question. And that's one that a lot of companies face because oftentimes their upper management is just focused on the P&L and they're not looking at the cash flow or the balance sheet. So one of the main reasons that the company can appear profitable but still have cash flow problems is just due to the timing differences. So we'll use the one we've been discussing because that's the simplest example is between revenue and cash collection. So as we mentioned, the revenues are recorded when the good or service is delivered, but the cash, it doesn't mean the cash has changed hands. And then as Jessica talked about, if it's taking the company a long time to collect on the receivables, like longer than 30 days, the company might not have enough cash on hand to pay the related short-term expenses that are due. And then another area that I can think about is a company that's making large capital expenditures. Say they're doing a computer refresh at their company and they're buying everyone new computers. That's a huge expenditure, but it's recorded on the balance sheet, and then that would be depreciated on the P&L. So if the investments are really significant and you're not paying attention to it, it could also result in cash shortages. So to sustain operations, the management needs to look at the cash flow statement and the balance sheet in conjunction with the P&L to make sure that everything is working as expected.
Thank you, Stephanie. That's exactly true. The cash flow statement matters because while profits are important, the cash flow, it's what keeps the business running. So a company can be profitable on paper, just as you pointed out right now, Stephanie, but it can still run into trouble if it doesn't have enough cash to pay its bills. So what is a cash flow statement? A cash flow statement is one of the key financial statements that shows how the cash moves in and out of the business for a specific period, such as a month, a quarter, or a year. So it's important for understanding how a company generates and uses cash. It's crucial for the day-to-day operations and long-term financial health of a company. So the cash flow statement shows how the changes in the balance sheet accounts and income statement figures affect cash and cash equivalents. It's really looking at the change in cash from the beginning of the period that you're looking at to the end. So that difference in your cash, you want to see where did it come from? And it will be in one of three main categories on the cash flow statement. It can be the cash flow from operating activities, which is primarily what we've been talking about, cash flow from investing activities, and cash flow from financing activities. So let's get started by looking at each section. So the cash flow from operating activities. This section shows how much cash the business generates in its regular day-to-day operations, like selling products or services and paying for expenses like salaries, rents, materials. When we look at accounts receivable, it's important to remember that we've recorded the revenue, but we have not received the cash. So when adjusting for net income, we would need to subtract out AR because that cash isn't in our hands yet. Similarly, with an increase in accounts payable, we would adjust by adding the differences back since we haven't actually paid the cash out yet. So for example, on your income statement, you could record a telephone bill as an expense. Now that would be reducing against that revenue for that month. However, if you haven't paid that bill yet, we've only recorded it as a liability on the balance sheet, meaning we still have the cash in hand. So in this section, we make those adjustments, often referred to as truing up, to reflect the actual cash flow impact of these operating activities. So this ensures that we're accurately reflecting the company's cash position, which is crucial for understanding the true financial health of the business. To me, this is probably the most important part of the three components of the cash flow statement, because it's actually showing how your operations or what we do day to day is the core business, how it's performing. So the second section is the cash flow from investing activities. This part, it tracks investments in the business, like if you're buying equipment or computers or a building, real estate, another business line of business. It also includes money that the company earns from selling assets or investments. So it shows how much the company is investing in its future growth or selling off assets to generate cash. So this is also an indicator if your operations is having a negative cash flow and you look at this statement and you see a company is now maybe selling parts of their business or real estate or something. It could be because they're trying to help, bridge that gap. Or, it could be that they're also trying to erase maybe their, real estate, footstep, so it doesn't, you have to understand what the strategy is for a business and not just, assume something. So the third section is the cash flow from financing activities. So this section is where the cash is coming in or going out from financing activities. It reveals how a company is managing its capital structure, whether it's raising funds or paying back debts. There are two different types of ways you can raise capital. That could be through financing, through either taking out a loan or issuing stock to investors. So if a company chooses to take out a loan, it'll receive the cash up front, but there will be immediate obligations, including regular payments and interest that will start right away. So this can also put pressure on cash flow, but the benefit is that the company retains full ownership and control. So on the other hand, a company can raise cash by issuing stock. It's essentially selling a portion of its ownership. This means that the company might give up voting rights, and depending on the type of stock, it may need to pay out dividends to shareholders. So while there's no debt to repay, the downside is sharing ownership and future profits with investors. So both approaches have their trade-offs. It depends on the company's specific goals and financial situation. So just to summarize, if a company takes out a loan, sells or buys back their stock, or repays a debt, it will show up in this section. Sometimes it gets a little confusing where people see that there's stocks being purchased or bonds, and that's actually part of an investment if the company is investing into other companies. So the next item we're going to look at is to review the cash flow statement. So we start with net income. In this case, we had a net loss, and you adjust the additions for cash or the deductions for cash. A decrease in AR on the balance sheet means we received cash from prior revenue in operations, and therefore we're increasing the cash from the operations. When you see an increase in the AP, it means while we've accounted for the expense on the P&L, we didn't send the cash out yet. So we're going to add that back in. And here we have net cash from operations at a positive $1,698,000. So that's actually telling the story that we're actually producing more cash than we're spending. So for the operation piece. The next section for investing, the net cash flow is negative 4,000, but that's due to purchasing computers. Again, that's I think a good story to tell because you're investing in your growth in the future and making things more efficient. Your employees need to have systems that work and are functioning, quickly and fast. So the next section has that net cash flow from financing. In this example, it's $5,000. This is due to receiving cash from a loan of 10,000 and also paying out dividends to your shareholders of 5,000. So the combination of these three categories is $2,968,000. So noting that we had positive cash flow from operations, but mostly the cash inflow of the loan is what kept the cash for this example in a positive position because we had that outlay of cash for those computers. So this matches the change between the cash in the beginning of the period to the end of the period on the bottom of the statement. So key things to look at on a cash flow statement is that net cash flow. This shows if the company has positive or negative cash flow between those three categories. Positive cash flow means that the company has more cash coming in than going out, while the negative cash flow means it's spending more than it's bringing in. The cash position, it's the ending balance of the cash, and it shows how much cash the company has on hand at an end of a period, and that will tie to the cash and cash equivalents on the balance sheet. So sustainability, if the company is consistently generating positive cash flow from those operating activities, it's in a good position. If it's relying on financing and borrowing money or selling assets to stay afloat, that could be a huge warning sign. So in simple terms, the cash flow statement, it tells you where the company's money is coming from and how it's being spent. Divided into those three activities, operating, investing, and financing, it gives you a complete picture of how the cash is moving through the business. It helps assess the company's liquidity, sustainability, and the ability to grow or manage its debt. So a healthy cash flow ensures that a company can keep running smoothly, invest in growth, and meet its financial obligations. So that pretty much summarizes the cash flow statement. Those are the three main statements that I review, the P&L, the balance sheet, cash flow statement. I personally love all three. Do you like the P&L? I'm going to ask you guys, which one is your favorite?
Mine is actually the cash flow statement, I would say, just because it has everything there that you need to see. It's got elements from the balance sheet and the P&L, but it tells you the story like you were talking about. You can see how well you're generating cash from your operations, but then you could also see what other activities the company's doing, whether they're spending money investing in the company or if they've had to borrow money or raise capital. So
I think for
Awesome.
me,
Jessica? Yeah, I was going to
as
say.
to say, for me, how do you pick, right? But I think I'd probably choose, oh man, you really put me on the spot here. Probably choose the balance sheet. Because I'm not a CPA, I don't have a very formal background in some of this stuff. To me, the P&L is easy, it's approachable, it's built for people that maybe are not as finance oriented as someone who has an advanced degree in that. But again, I mean, I think they all definitely serve a purpose and they're all very helpful in their own way.
Awesome.
That's great. Well,
I guess we should check the chat real quick. I don't
yeah,
see.
I don't see any questions in there. I do
Oh,
see we only have 2 minutes left. I think I'd like to say, if you don't have any questions now, but if you have questions that you think of later, feel free to reach out to me or to Nicole or Jessica. We're definitely available out on LinkedIn, right? And so if you think of anything, and then this is also being recorded. So if you needed to go back and watch any of it, that's available to you as well.
Yeah, and I would say we're probably three people that would enjoy to talk about the financial statements with anybody. So ask away.
Yep. All right. Well, I think we're going to be signed off soon. But thank you again very much for your flexibility and letting us present this a little week later. We appreciate the extra time to deal with the hurricane. So anyway, thank you
Yeah.
very much.
Thanks,
All
everyone.
right. Bye.
All right,
Bye.
thanks. Bye-bye.